conversation. Welcome again. Welcome, Julian Morrison. Stuart, we're really happy to have you today. Just you can take it away.
All right. Well, thank you very much for having me here, Simon, and welcome everybody that's tuning in. I was telling Simon this is my first time on live on YouTube, so please bear with the novice right here. All right. So background. I work in the finance sector. I'm an associate actor at Sagicor. I work in the field of post retirement benefits, but I do have a lot of interest in investments, and I guess that's why Simon asked me to do this presentation. So the presentation is on investment returns, and I'm gonna go on and discuss what are they, why they matter, and how to determine them. All right, let's go. And so again, thanks again, Simon and the Stocks on the Rock team. I think you're doing a great thing in spreading this financial literacy, and I align pretty well with this mission. And I wish you all the best in your endeavors. So as I mentioned before, for this presentation, I'll go through the what, the why, the how, and as well as a demonstration of how to calculate investment returns. So, I mean, I'm on Twitter these days. I just joined recently. Well, in the pandemic, everything seems like yesterday, but I saw this tweet on Twitter and I thought it was absolutely hilarious. I think it was about the time in March. In It was when, I don't know, earlier this year, there was a big drop in the stock market in the US, and this guy, he has a famous account, and he said if you invested $10,000 and you lost 50%, you'd only need to put another $5,000 to break even. And I mean, I thought it was pretty funny, but then again, I have a very dry sense of humor, and
Yeah,
I
that's an
just
actual joke.
yeah. So I just hope at the end of the presentation, and with what I've presented, that everybody will be in on this joke as well. So, what are investment returns? So, and this is a very primitive question that we have to answer before we dive any deeper. And so, when Simon asked me to do this presentation, I put pen to paper and I put, some words that came to mind when I asked that question. And I also went and did some internet search, and I collated some of the main words that came up. Words such as goals, appreciation, measure, portfolio returns, quantify, very important. And so what I did after that, I collated all of those and put them and distill them into one single definition. And to me, investment return is a standardized way of measuring your gains and losses on an investment or a portfolio of investments. And so we'll touch on that much further. So first, we need to understand one, it's a standardized measure, two, of gains and losses, and three, of investments or a portfolio of investments. So in terms of, so that was pretty quick. And I guess I have to kind of slow down to use up some of the time that Simon gave me. But let's now jump into why we measure investment returns. So in terms of why we measure returns, I thought of this philosophical question, and it's, if a tree falls in a forest and nobody's around to hear it, does it make a sound? Simon, what do you say?
Yes, it makes a sound, even if nobody hears it. But I'm no philosopher.
You're no philosopher. And Julian, what about you?
Yeah, it depends on who's asking, but I agree with Simon.
I know you'd be that depend kind of guy, but the truth is, I mean, I don't know the answer, but most people that I asked before I did this presentation, they said that yes, it makes a sound. And I guess I understand the reasoning. You might be wondering though what this has to do with investments. So I'm gonna tie it in right now. So a spin-off to this question for investment purposes is, if you were to sell an asset and you did not measure the investment return, was it really an asset? Or was it really an investment? And the funny thing is that even though everybody told me, yes, the tree makes a sound when it falls in the forest, some people also said yes to this question. And I hope that at the end of this presentation, that people recognize that, to me, if you don't measure it, it can't be an asset and it cannot be an investment. Why? Because investments follow from investment goals, right? And all investment goals have to be SMART goals. SMART goals are specific. You know exactly what the goal is. It's measurable. You know to quantify it. It's attainable. You know that you can get it. It's relevant to whatever your broader mission is, and it's also time bound. So all investment goals have these qualities. And so where investment returns fall into this, I'm going to touch on later. So let's go through two types of goals here on the screen. So the first one is to beat inflation. And to me, that's not a SMART goal, because it definitely, it might be specific. You might be able to measure it, right? But is it time bound? Do you know over what period that you need to beat inflation? That's something to consider. In terms of the second goal, here it is: to save and invest $40,000 monthly and earn at least interest rate of 24% per year, so that you can have a deposit of $2 million to help purchase your first home in 3 years. This goal is a SMART goal. And so it hits all the metrics of SMART goals. Let's dive deeper into this one. In terms of the measurable aspects of the goal, you'll notice that it has two measurable aspects. The first one is to earn a rate of return of at least 24% and to accumulate a deposit of $2 million over a 3-year period. So you know exactly what you want to do over a given period of time. And where investment returns fall into this mix is that it allows you to evaluate the goal. It gives you a measure of saying, yes, I know that I've achieved this objective. Which brings me to the other principle, which is that investment returns provide a metric to evaluate SMART investment goals. And this is very, 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 very important. So since at the end of this presentation, we all need to know how to calculate returns. We need to just know some basic things, and you just have to know them in order to do it. One of the first things is understanding the language and knowing what we call in investment parlance CAGR. I hope I pronounced it right. So CAGR, this definition was from Investopedia. I just like to think of it as a geometric average return. So you would have a simple average where you add up the rates of return and you divide them by the number. A geometric average, you multiply the compound returns together, and then you average them using the law of powers, right? Don't be daunted by the math. I just put that there for representation purposes. So let me go through an example. So if you had a year one return of 6%, a year two return of 14%, and a year three return of 10%, you see that you multiply the compound returns there, and then you average them to the third power, and then the resulting compounded return is 9.95%. Now, I know some people in the audience are probably saying, wow, this guy, what's the hullabaloo about this? 6 plus 14 is 20, plus another 10, that's 30. You divide that by 3, that's 10, that's basically 9.95. So what's the hullabaloo about this? But the truth is that as you go up in terms of numbers, this compounded return gets drastically different, and that is because of the law of compounding. Another thing that we need to know is the notion of gross returns and net returns. I don't even know why they used to call it gross returns, because any return that was positive to me couldn't be gross. But anyway, gross returns are returns before fees.
Bro, you're terrible. You're terrible. I'll continue.
Yeah, gross returns are returns before fees, and net returns are returns after fees. Just something that you need to know. So in terms of an example of gross and net returns, if you were to buy an asset for $100,000 and you paid $1,000 in fees to purchase that asset, and then you turned around and you sold it for $125,000, paying fees of $1,250, that's a 1% fee on both transactions, you'll see that the gross return when you've sold that asset is 25%. You take the closing value less the opening value, divide by the opening value, 25%. The net return, same type of calculation, but at the top you deduct the fees that you paid. And so what you'll notice with this is that fees actually reduce owner returns, and that's another principle that I want everybody here to know. And so the higher fee, the more fees that you pay, the more that they eat into your investment returns. And so personally, I try to minimize how much fees I pay in my investment journey. So let's build on that example. Same example, and let's apply the CAGR to it. You'll notice that over a 1-year investment horizon, the CAGR, the net CAGR, is still 22.75%, as was there previously. But then as you go down in terms of time span, the CAGR actually reduces. And so this is a very, 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 very important principle, because even though the return on the investment is the same, it differs over time. And this is because money has a time value, and a dollar today has more value than a dollar tomorrow. And so I actually saw some tweets circulating today about centered on this. I believe it was some fixed deposits. Somebody put some money on a fixed deposit, and at the end of, I think, 10 or 7 years, they only got 7% total return.
Yeah, it was learn, grow, and invest.
Yeah. So to me, that emphasizes the notion of the time value of money, because even though the money would have grown at a total rate of 7%, the money is actually worth less today because of inflation, because inflation was actually higher than 7% over that total period. So now, with those basics covered, let's now look into different ways of determining investment returns. So these are 3 main methods, and I can say right off the bat that I tend to use the simple net yield as well as the money weighted yield. The money weighted yield is what people call the internal rate of return, and so I'll touch on this later. So the simple net yield, it simply measures the investment yield, assuming that the cash flows occur uniformly throughout the year. The time-weighted yield is essentially a measure of how $1 invested at the start of the period would have grown to the end of the period. And the money-weighted yield is a yield considering the timing and amount of all cash flows that were made throughout the period. So when we look at the simple net yield, as I mentioned before, it assumes that the cash flows occur uniformly throughout the year. So essentially, that's basically the same thing like saying all cash flows occur in the middle of the period because of that uniformity. And so here, the yield is comprised of 2 components. The first component is the interest on the asset at the start. So the asset at the start gets interest for the whole period. right? For the cash flows that are made, which are assumed to be made at the middle of the period, they only get interest for half of the period. And so both of these two items contribute to the asset at the end. So I've called the asset at the start A naught, the net cash flow, and this is the net cash flow excluding fees, right? And the asset at the end, which is A1. In terms of what it looks like in a formula, you have the closing asset equal the opening asset plus the cash flow plus the interest. Guys, don't be daunted by this formula. I just put it there for informational purposes. So let's go through an example. So you had a stock of a company valued $25,000 at the start of the period. During the period, you deposited $27,270 into your brokerage account, and then you use this to purchase another share of the company, which costed $27,000. Obviously, it is not a stock on the stock exchange. Nobody would buy it, maybe. They would say it's too expensive. But yeah. And in that process, you paid fees of $270. So at the end of the period, you now have two shares, and they're worth $60,000. In terms of the net yield is simply the ending value of those two investments, 60,000, less the opening amount, which is 25,000, less the amount that you funded your account with, 27,270, and you add up, you do that calculation at the top, and then in the denominator you have how much the stock was valued at the start, and then you take your net cash flow and you divide it by 2, because it only contributes to 50%. It only contributes a half year's interest, right? And so when you do that calculation, you get the net yield. In this case, it was 29.5%. For the time-weighted return, I won't spend a lot of time on the time-weighted return, because I think for retail investors, it might be something difficult to compute over time. But what the time-weighted return is, it's a measure, as I mentioned before, it's a measure of how $1 would have grown throughout the period if it was continuously invested, right? And so for the time-weighted return, every time that there's a cash flow, the return on the investment is calculated, and you note that return. And then when you have another cash flow, you calculate the return again. And then you do that for all sub-periods until you covered all of the cash flows. And then at the end, you find the compound average of all of those returns. And then the result is the time-weighted return. Now, the time-weighted return, I wouldn't necessarily, as an owner, I wouldn't necessarily use this to measure investment return. Why? Because you have control over your investments, and you have control over when you make those deposits and the withdrawals. Because the objective of a time-weighted return is to really know how money at the start would have grown if it was uninterrupted. For owners, I think the money-weighted return, or the internal rate of return, the IRR, is probably one of the best measures of your owner returns. In terms of how to think of it, I think of it like a balance in the scale. So you would have your starting investments and your cash flows that you made throughout the period, and the cash flows would be your deposits and your withdrawals, your dividends. And so what the IRR does is that it balances the scale, so to speak. It's the rate of return that would make the cash flows, that the investments that you had at the start plus the cash flows that you made during the period with interest equal in value to the ending value of your investments. In terms of how to find the IRR, well, the steps include, you need to get all the details of the cash flows that you made. As I mentioned, this would include your deposits, It would include your purchases and your withdrawals. The second step, you need to know the value of the investments at the start and at the end of the period. Third step, you need to find the interest rate that would make the future value of those the value of your portfolio at the start, as well as the cash flows that you made throughout the period, deposits, withdrawals, etc., equal in value to the ending portfolio value. And then the fourth step is that once you find that rate, it is the IRR. It's essentially a break-even rate for those for that equation. So in summary, right, we just went through three types of measures for investment returns. The first one was the net yield. I like to use the net yield because it's quick and easy, and it gives you a fair estimate of the yield. However, it's not very appropriate if the cash flows during the period were lopsided. And remember that I had said that we use the net yield when the assumption with the net yield is that the cash flows that occur during the period are uniform. For the time-weighted return, I would say you use this when you're comparing different investments, where the investment vehicle itself or the investment manager doesn't have control over the cash flows. So, for example, when you're comparing unit trusts or investment funds. However, calculating the time-weighted return is very tedious because you have to recalculate the return at every time that there's a cash flow. And so, sorry. And so investors, that's very impractical. The dollar-weighted return, also called the IRR, as I mentioned before, I would say you use as investors is one of the best measures for your investment returns. And we use it because we have complete control over our cash flows. And it's not tedious to calculate. However, it's best to use like a spreadsheet software to find it because it's a numerical problem. So let me demonstrate quickly an example of the IRR. So here, can you guys see the screen?
You might need to zoom in a little bit more. Yes, I can see it. Julian,
Come on, it's fine.
Okay.
can someone on YouTube just confirm? Yeah, man, you can go ahead, Stuart.
Yes. So what I have here is a model portfolio. A friend of mine donated the transactions since they started investing last year for demonstration purposes. So here I have all the cash flows that they made from November 2020 up until now. Have them in an Excel sheet. I've shown the date, the type of transaction. For this example, it's the only transaction that this person did was making deposits, trades, which would be the purchase of securities on a stock exchange. They also paid fees as a result of those trades. They received dividends. So those are the four major transactions that took place. I won't go through all of the purchases. However, here you'll see the consolidated holdings. Here, for the portfolio view, it's very important that you incorporate cash into your portfolio. Right? A lot of people don't consider, as long as you intend to invest that cash, it should be in your portfolio. So here you'll see the person has a limited amount of cash in the JTrader Pro account. That's the online platform that allows you to trade on the Jamaica Stock Exchange. They also accumulated some dividends in the fairly nascent investment journey. And then here you'll see the different stocks that they own, right? And the valuation for these stocks. This might not be so accurate, but it's the concept that counts. So here you'll see a portfolio view of the overall portfolio and an allocation across the different asset classes, across the different investments. In terms of a statement of account, recall that they started in November 2020. So what we did was to measure the investment returns up to December 2020, and then from January 2021 to yesterday, which is year to date. And so since they just started, the portfolio starting value was zero. They would have only invested roughly, sorry, let me zoom in a bit more. They would have only invested about $132,000 up to December 2020. During that period, they did make some transactions, right? So this is another important thing. So even though trades were made, right, where the trades will be captured is in the value of the investments, right? But for portfolio purposes, what you really should be concerned about is the capital that you invested. So in this case, they invested $132,000. They made no withdrawals. They made some trades and incurred some fees in the process. And so that had eaten into their investment returns. So you'll see for the period, the ending value of the stock, this is based on the 31st December 2020 quote from the JSE. They publish the return, well, the stock prices at the end of each day based on the value, based on the stock prices at the end of December 2020. This was the value of all the stocks that they held. And this was the amount of cash that they had in their JTrader Pro account, which led to a closing portfolio value of $139,000. So you'll notice that the difference between that and how much that they invested, right, is the investment income. In terms of the yield, I use the same standard formula that discussed earlier with regards to the simple net yield, and I did it on a gross as well as a net basis. So this emphasizes the fact that even though that the portfolio itself returned a 13.1% gross return up to December, the net return after fees was actually lower, which was 11.2%. And so we did the same thing for January 2021 year to date, and then combine those two return periods into a single period here. And you'll see that the valuation of the stocks at the end of yesterday was $534,000, roughly $500,000. And then they accumulated cash after the trades of $145, as well as dividends. And that contributed to a gross yield of 23.5% and a net yield of 21.4%. So this is a quick and easy snapshot of what the portfolio returns had looked like. And I tried to present it in a way that I think a lot of persons are accustomed to seeing statements of accounts in this way. I'm not, in my line of work at least, a lot of finances are prepared in this way. And so in terms of the dollar weighted yield, and to me, this is the more important of the two. I'll show you the dollar weighted yield on both the gross and the net basis. What I did here was to essentially set up the transactions.
Can you zoom in a bit? Sorry to cut you, Stuart.
Yeah, man, no problem. So here I did a setup of the dollar weighted yield. For the dollar weighted yield, we'll have to first know the period that we're evaluating the yield over. In this case, it was November 25th, 2020 to July 29, 2021. The starting portfolio value was zero. The ending portfolio value was roughly $500,000, and that includes the cash and the accumulated dividends, which have not been invested. So here you will see all of the cash flows that occurred during the period. So you'll see the deposits that the person made, as well as the fees that they incurred whenever they made trades, right? What we'll do here is that we have to bring all those cash flows to the end of the period. You have to accumulate them with a rate of return. And so you'd have to, for example, this deposit that was made at the start of the portfolio, right? It would have earned interest for 246 days, which is 1 day less than the total period, because it was invested at the end of the day. Likewise for the other set of deposits. The fees would have incurred interest, so to speak, at the same rate, however, for a different amount of days. So essentially what we have to do now, and what I'll do, I'll try to create a version of the sheet that is shareable. Simon and I will work through this so that you can actually see the computations. So what I'll do now is to just show you how the IRR actually balances the equation. So you'll notice here that when we add up all the accumulated values of those cash flows here, we get a certain amount of money, $478,000. That's actually less than the ending portfolio value. So we need a rate of return or interest that can balance that equation and close the gap of $56,000. And here, I'll use the Excel as a feature called Goal Seek. I'll go here to Goal Seek, and I highlighted the cells that are relevant for this purpose or demonstration. And so this set cell is the difference, which is the gap I'm trying to close. I'll set it to 0. And what I need to do is to change the dollar weighted return for the period, which is this rate right here, which feeds into this column here. And so I get a rate of return of 22.8%. When it's annualized for the full year, it's 35.5%.
Wait, hold on. So, Stuart, talk to us now. When you say annualize, what do you mean? Talk to me.
Right. Okay, so when we talk about annualize, the annualize is essentially the rate of return that the money would have earned if it were invested for the whole year. In this case, the period was 247 days, so roughly 9 months, right? And so if it is that that person were to earn the same rate of return for the rest of the year, the total return for the year would have been 35.5%. So I've essentially converted a 9-month rate into an annual rate by annualizing. And you guys will see that, for example, with your credit card. You will see that your credit card might charge an annual rate of 48%, right? And that works out to roughly 4% monthly. Clear?
Yeah, that's right.
Okay. So I'll do the same thing with the, so that was the gross return. And so for the gross return, I had included the fees to show you what the gross return would have been. For the net dollar weighted yield, I've excluded all those fees and just looked at strictly the cash that had been deposited into the account, and let the rate of return take into consideration the fees that would have reduced that owner return. And so I'm going to do the same thing. Go back to our goal seek. I'm going to set this cell to 0 and find the rate of interest that will close the gap. And you'll see here that the dollar weighted yield was 20.7%. So it was actually less than the previous gross yield. So in summary now, I've just shown here a summarized result of the portfolio. So the person started with a portfolio of essentially no portfolio at at the start of at the end of November, they deposited roughly $500,000, and then they earned $51,000 over the period to end up with an ending portfolio value of $535,000. When you look at the simple net yield on a net basis, it was 21.4%. And then when you actually look at the dollar weighted yield or the internal rate of return, it was a little bit lower of 20.7%. And you can find that at times that the difference, there's a difference between the actual simple net yield and the internal rate of return, because the internal rate of return is actually more specific. It takes into consideration the actual timing of all your cash flows. And so if you have idle cash sitting down, so for example, dividends that weren't reinvested, they will drag on your returns. All right, so let me head back to, so that was the end of the demonstration. I'm gonna head back to the presentation. So in terms of the frequency of measurement of your investment returns, I'm someone, I might check my stocks every day, but I don't necessarily measure my portfolio returns every day, if that makes sense. So I think the frequency of measure.
You just look to see if they're still there.
What's that?
Look to see if the stocks are still there.
Yeah, man, I just look to see that the money's still there, you know. But yeah, I don't necessarily measure my portfolio returns that frequently. I might do it every half year or so, or every quarter. But whatever it is, the frequency of measurement of your returns, it should tie up with your investment goals. And so if you have a timeline of a year, an investment horizon of a year, you should possibly measure your investment returns monthly. If you have a timeline of 5 years, maybe quarterly or annually would be appropriate. And if you have anything longer than that, say 10 years or more, maybe annually is an appropriate measure. But this, as I said, this depends on you and your investment goals. So let's go back to this meme, right? And I hope that with the information that I presented, that we can finally see the truth in this statement. So you invested $10,000 and you lost 50% of it. You put in another $50,000. So essentially, you have $10,000, but you invested $15,000. So you actually have a minus 33% rate of return. You actually haven't broken even. So a nice little joke. And it ties up with the last investment principle, which is that numbers do not lie. So do not trick yourself, guys. Do the math, do the numbers, put pen to paper, do up your Excel sheet, track your investments on whatever app, but the numbers do not lie. And that's very important. So the key takeaway messages that I have for you at the end of this presentation is, one, that investment return is a standardized measure of the gains and losses on your investments or your portfolio of investments. They are also a metric for evaluating your smart investment goals. The other takeaway is that fees reduce owner returns, and this has been demonstrated through both the gross return as well as the net return. Another concept to know is, and it was displayed through the compounded average growth rate, is that money has a time value, and $1 today is worth more than $1 tomorrow. The money weighted return, or the internal rate of return, is probably the best measure of owner returns. And the last takeaway is that, unlike other things, numbers do not lie. And so with that, I will close off, and I'll hand off to Simon and the rest of the team.
All right, there's a lot to unpack. There's really a lot to unpack there. Firstly, thanks, Stuart. The guys that are online on YouTube and Twitter, remember that we are taking your comments now and your questions. So I will, Stuart, what I'll do is that as they send in their questions, I'll just place it on the screen. But there's a lot to unpack. Boy, okay, let me start somewhere in the middle. The first question that came to mind, you said that it is important for us to include cash when we're talking about our investment portfolio. I was wondering if you could expound on that a bit. And Julian, I mean, you can also chip in.
Yeah, yeah. So let's start from the fundamental view that a portfolio is a collection of assets. Yeah.
Mm-hmm.
If you intend to invest the cash, right, then essentially it is a type of investment, but it's actually not earning any interest, right? And so from that point of view, anything that you intend to invest should be a part of your portfolio. So I know some people they might say, well, I'm just gonna look at the stocks that I have as part of my portfolio, and they don't consider the fact that they have a big pot of money sitting down that they intend to deploy that they have not deployed as part of the portfolio. And I think that is not the best approach.
Mm-hmm.
And so for completeness, I think you should view cash as part of your portfolio. And so you have tiers to your assets. You have your cash assets or your near cash assets that tend to earn nil or very low rates of return. So, for example, a fixed deposit, cash in your bank account that earns a measly rate of return that you intend to invest. That's not your emergency savings. You also have longer fixed deposits. You have your investments, which might be mutual funds or your your um, your any type of mutual fund and your investments. So any of those things that you have, you should include in your portfolio of investments because they affect your investment returns differently.
Okay. And I get that. My how I look at it is cash is a part of your overall assets, and
Yeah.
cash creates what we call a cash drag. So if you like think of your investment journey like a chariot, a cash drag would be if you were like the Flintstones, and you put your foot down on the ground. So while you're trying to move, it's kind of holding you back
Yeah.
because the cash creates what we call an opportunity cost.
Yep.
So what
Definitely.
could you do with this cash?
Definitely.
So if you can calculate, and I realize it's good, you have it in your presentation that if cash, what percentage of your total portfolio? I'm not sure if anybody caught that. What percentage of your total portfolio is cash? If the percent of your total portfolio that is cash is 30%, that means that you can afford to invest more. Now, I am not a proponent of having $0 in cash because if you have an emergency Sunday night at 3 a.m., you can't access the cash in your investment portfolio, right? So I am a proponent of having free cash in your bank account for um, transactions or emergencies. But certainly, it's a pet peeve of mine when people are calculating investment returns and don't include cash in the portfolio. So what I do, Stuart, is I have a page that, and trust me, my guys, my investment portfolio X sheet don't look like Stuart one. Stuart one is a lot more formalized. But I have a thing that says overall asset classes. Equity is X% of your portfolio, cash is X%. So there was a time where I sold one of my large holdings and my cash jumped up to 30%.
Yeah.
And what this told me is that, oh, I need to make a decision now because this cash needs to go back at work. That's
Yep.
lazy cash. So as you had said in the start of your presentation, having putting your investment returns or the numbers of your portfolio in front of you kind of gives you a way to make investment decisions and to make better, smart investment decisions.
Correct.
We have
Correct.
a question from Randy Davidson. When calculating investment returns and checking against inflation, purchasing power, is there a more objective benchmark than USD? Hmm. Sorry, you want to go first, or you want me to?
I mean, in our world, you have to use what you have, right?
Hmm.
And the available information is inflation. So typically, asset managers here in Jamaica, they will. It depends on the investment goal of whatever fund or your own personal investment goal, that determines the benchmark that you use to compare your investment returns to. So if you are investing strictly to beat inflation, then your benchmark should be the inflation rate. If your benchmark is a portfolio of US dollar investments, denominated investments, then you should probably look at devaluation. I don't know. I'm just saying. So
Hmm.
whatever your investment goal is, the benchmark should be suitable for comparison. In terms of the question, it seems to be talking about purchasing power. And so in this case, it depends now. The mix, I would say, how you spend is broken up. So if you spend mostly J dollars, then I would think that the J dollar inflation rate, which is published by Statin through the CPI basket, it would be an appropriate measure.
Yeah, thanks for that, Stuart. So, Randy, I mean, the last part of your question kind of threw me off, as it pertains to the more objective benchmark than the USD. I am assuming that you're speaking about USD inflation. You can just let me know, or USD devaluation, maybe, or depreciation. But from what I understand, when start to consider the USD and different changes or macroeconomic variables around the USD is when your portfolio is exposed to the USD. So that is like when you have USD assets. So as Stuart would have stated, the evaluation becomes important, or the inflation rate in the US. For us, naturally, in Jamaica, naturally, we want to beat inflation, which is somewhere between 4 and 6% now. It's probably going to touch the roof of that sometime this year. But personally, what I do for benchmarking is I try to benchmark against the market. So, how did the market perform? So, I predominantly invest in Jamaica. So, if I'm looking at equities, I'm saying, okay, how did the JC perform versus how did I perform? Or I have what we call an absolute return, which is for this year, I want to beat a return target of 40%. So that's not based on any inflation or USD depreciation or anything like that. It's really just based on me. Mel's had a question, and Stuart, this is definitely yours. How do we decrease or minimize the fees charged for transactions?
All right. There are some basic ways. The first one is to, if you have a broker, find a broker that charges the lowest fee, but know that you have a trade-off between the fee that you pay and the value that you get from your broker. Um, in terms of you in yourself, you can reduce the number of transactions that you do over time. So instead of buying and selling a stock over a short period of time, you just buy and hold. That's another thing that you can do to reduce the amount of fees. And just be very strategic about your purchases and your sales. You know, weigh your opportunity costs whenever you're making investment decisions. And I would say stick to investment framework so you can be very deliberate about the trades that you make.
Yeah, thanks for that. And of course, one of the best ways is just finding the broker with the the most opportune trading platform, such that the rates are cheaper, but you're getting the actual service that you need. Julian, your point here.
I was going to say that what Stuart highlighted is portfolio churn, or the turnover rate of the portfolio. And sometimes the investors, because the information flow is so high, because of how advanced technology is, you can see what people are talking about on Twitter. And there's a certain space now, people are talking about hot stocks and it's earnings season. So people saying, boy, look at what this stock did and look at what that stock did. You kind of feel away, so you want to sell what you have and jump into what other people saying. Those things can lead to portfolio churn and it can actually hurt your return. So you have to just stay focused. Stay focused. If you have a
Yeah,
support group, build a support group and stick to what your support group is saying, but don't watch the crowd, because it's not the crowd's goals, it's your goals.
correct. And that's why I like to
Yeah,
look
and I
at both
think
my.
Now,
Now I was saying like
sorry,
that,
go
that's
ahead,
why I like
Stuart.
to look at both my gross return and my net return, right? So I can actually see it in front of my face how much I'm giving up because of the frequency of the trades that I'm making. Because some people will say, all right, well, I'm gonna jump out of this investment, jump into this one, and then jump back into this other one. And then when you look at the overall net return, you basically eat up some of the gains that you made through the fees. So it's very important to consider that whenever you invest in.
Yeah, thanks for this DK Jazz. It is actually, and it's very important. I mean, Stuart said it a few times. I'm going to repeat it again. It's very important to have those numbers for your portfolio in front of you, so that you can understand the performance of the portfolio, because you could be thinking that your portfolio is making X amount of percent, 80, 90%. But when you account for all the expenses for that portfolio, it's not. Another thing that I came across, Stuart, was what they called implicit costs. So costs that, for example, one of them is the cost of just waiting. So you made a decision on the 26th,
Mhm.
and the price was at $10, but the trade was executed on the 27th, and then the price move up by 60 cents. That's a cost of waiting that you just went through.
Yep.
Another one was your market impact cost. So let's say that you're trading, tell me a thinly traded stock, Julia, Knutsford.
Finley, yeah, possibly,
Yeah,
or
Yeah,
T-Tech.
yeah, Knutsford or T-Tech, but you want to buy a large volume of units or to sell a large volume of units. The second you put that large volume in the queue, it changes how some investors look at the queue.
Yeah,
Oh, this person wants to buy a big block. Okay, I'm gonna clear all of my orders and add $2 to it. Or this person wants to sell a big block. It's going to restrict the amount of trades that I want, or I can pull down the price because they're willing to buy at any price. So that's just another thing I wanted to include. Implicit costs. Thanks for this comment, DK Jazz. Chike had a comment. Chike is one of the key members of the Learn Grow Invest community. Big up yourself, Chike. Noted that beating inflation is not a smart goal, but if my goal is to ensure my portfolio outperforms inflation or any currency devaluation, what is a more reasonable, smart goal targeting?
Okay, well, we can just convert that so it's just a bit smarter. So Chike, you might want to outperform inflation, yes, but maybe you could say that I want to beat inflation by a margin of 2% over a 40-year period, so that when I come to retirement age, and I'm sorry if I'm aging or making you younger than you are, Chike, so that when I come to retirement age, I can have a good nest egg and ensure that the funds that I've accumulated can maintain my purchasing power. So that's a smarter goal, Chike. You know that one, the goal is over 40 years. You know the measure by which you're supposed to beat inflation, which is 2%. You know how long you're supposed to do it for, and you know why you're doing it. You're doing it for retirement, so it's relative to your own personal objectives. And I would say that it is definitely an attainable goal. You have some investment managers that have been beating inflation by a margin of 2%. So that's how I would convert it.
Yeah, yeah. I echo Stuart's comments. I'll add to that. Um, have another question from Matthew Preston. Aren't all of our portfolios technically exposed to US directly or indirectly? I have a comment here, Stuart. So the thing is, yes, if you invest in a Jamaican, let's say a Wisinko, if you invest in Wisinko, you are exposed to USD, let's call it depreciation, right? Because Wisinko itself may have costs or revenues that are based in US dollars. Mostly it's usually costs because they sell predominantly in Jamaica. So it's usually the costs that are denominated in US dollars. So your exposure is on the negative side. As our dollar devalues, their costs go up and they pass it on. The key is that they pass it on. So another thing to look at, and this is something I learned a few years ago, we have to look, especially in an environment where costs are increasing like this one, it's not enough for a company to say that their profitability or their gross profit is increasing by 3% when a part of that may have been negated by inflation or depreciation. They have to be moving by more than that. So I think one of the indirect ways in which you are exposed to that as an investor, remember you're an owner of the company, is through the exposure of the company itself. A direct exposure would, of course, be if you hold USD assets, such as myself. I own Netflix, so naturally I hold Netflix in US dollars, and as I purchase more Netflix, my US dollar portfolio increases, and as the Jamaican dollar gets stronger, I lose, or if it gets weaker, then it's overall better based on my reporting currency.
Yeah. I'm not sure what the context around this question was. So I mean it's a bit hard to comment on it, but I have a feeling that it ties into the first question that we got about the benchmarking. Um, One thing I would say though is that when you even look at the BOJ, the Bank of Jamaica, they target inflation within a range, and currently they target inflation within a band of 4 to 6%. When you actually look at the components of inflation, you have a basket of goods and services that people use, generally comprises food, electricity costs, insurance, that sort of stuff. I believe weave is in it too as well. I found that very funny. um,
No, no, Stuart. Stuart. Stuart, mine get in trouble, Stuart.
It's a basket. It's a
Mine get in
basket.
trouble.
right, so I mean when you look though at the components of the basket, right, there will always be a flow through impact of the US dollar exchange rate in terms of the currency devaluation, because a lot of those goods and services have a US dollar component either through importation or actual linkages to the US dollar. So, for example, your JPS bill is linked to the US dollar. If you buy a imported cereal, then the price moves in line with the US dollar. So there's a flow through impact through the inflation rate and I guess that's why the BOJ looks at the inflation rate as the sole rate that they're going to target instead of currency devaluation.
There is a rule in quotation mark, that central banks, they can't target interest rates, inflation rates, and the exchange rate at the same time. You have to choose two and let one go. Yeah, I think I saw it in a textbook or somewhere. So basically, you can't
Yes,
chase all
the
of them. You have to
Trinity,
choose one.
the
Yeah,
Trinity, the Trinity. But
you have to choose one.
I have a paper, Julian. I don't want to be too radical here. I have a paper that refutes that. So I'm going to share it with you. An academic quantitative
You
paper.
might love to see it.
Yeah, it's the same thing like business, right? They say you can either do it better, faster, or cheaper, but you can't do all three. But I mean, you look on a company like Amazon and they're just killing it, right? So
Yeah, but,
Yeah, and I would
yeah,
say if you innovate, you can do it better, faster, and cheaper. If you innovate, and that's the beauty with Amazon. Particularly the last couple of years, been very innovative.
yep.
I'm going to go left a little bit. I know we're talking about returns, but I want to go left a little bit. So there's a book called 0 to 1 by Peter Thiel. I know the spelling is Thiel, but you don't pronounce the H. It's Thiel. He's a strategic investor. He's an early investor in PayPal, um, and many other companies. And his book is basically saying the same thing we are talking about a while ago. Companies being able to do it all. But he's saying his argument is a radical one, in that capitalism isn't necessarily about competition in and of itself. Capitalism is really about defeating competition or wiping them out and accumulating as much capital as possible and putting it to work. So you can check out the book. It's really good. 0 to 1. It's a different school of thought, but it has a lot to do with returns, because you notice tech companies right now have a very high level of return as a sector. And it's because a lot of them are actually consolidating their power. They're actually approaching more and more of what is considered to be a monopoly model in terms of their influence over the market. But that's a different train of thought. It's just that we're talking about it. So,
Yeah,
the book explores that.
Yeah, man.
I'll check that out, Julian. I actually have a thought on that, but I'll share it with you
Yeah, man.
here.
Yeah, man. Yeah, man.
Randy responded. He said, "Those are fair answers. The scope I was asking that question in is just contextual, i.e., to have an idea of how well a portfolio is despite inflation. I'm assuming that beating inflation is an implicit goal of any portfolio, though it is not an ambitious or healthy one." Randy, I don't want Chike here. You said this. But yeah, yes. Actually, I agree with this. We all implicitly want to beat inflation. I mean, if we didn't want to, then putting our money in a fixed deposit somewhere would have been a good idea. So we all implicitly want to beat it, but I don't think for us as individual investors, it may be the best target. What do you think, guys?
Yeah, definitely. There's nuance to this, right? So let me stick a pin. So when I said that beating inflation is not a smart goal, I didn't mean that it wasn't a good goal. Beating inflation is a good goal, right? But it just doesn't have all the smart components. So that's the first point. Now, when you manage, we're talking about personal finances, I guess, right? There are times. Let's talk about some assets. Well, not assets, cash that you might have outside of the investment portfolio. Your emergency fund. You might not want to put that to work And even though it's not beating inflation, it achieves an objective of being available just in case you have an emergency. So there are times when you don't necessarily, beating inflation is not your main objective. And so you can consider that when you're arranging your personal finances.
Thanks for that. Matthew has a question. I think we touched on it a while ago. What are your thoughts on the CPI and its accuracy in assessing inflation? And I believe that this is coming off the same discussion about using inflation as your as a goal. I mean, my opinion is that inflation, the objective of inflation is not to capture the actual average increase or decrease in price for every single good in the economy. It's to capture the movement in price for a basket of goods that the average consumer will use. Average consumers use different sections of the basket. So, for example, Stuart mentioned that weaves are on the list. I certainly don't use a weave. So if weave prices go up um, by 300%, it doesn't affect me, but it affects the person that uses it. And I was looking at the CPI basket recently, actually. So it's actually, um, very good that we brought it up. And I realized, not realize, but the basket actually has weights with things that are maybe more or less important um, in the overall basket. So, for example, food and non-alcoholic beverages are stated as being an average good that almost, if not every single consumer consumes. So that has the largest portion of the basket at 30, so between 35 and 40% of the basket. However, when you look at the smallest portion of the basket, it is to alcoholic beverages and tobacco. Now, I don't smoke, and statistics will show you that a large percentage of Jamaicans don't smoke or don't smoke regularly. So an increase in that may not affect their overall basket. So I'm just saying the basket is supposed to just be a measure that is representative or as a proxy of price increases.
Or we can say they don't smoke what is recorded in CPI. Let's just leave it there.
I know it's
I
very
would hope
Julian,
that
but I won't go there.
I would hope that
Yeah. What
since
they
that
smoke
is
is not in CPI.
decriminalized, I would hope that since
So,
it's decriminalized, it would be included.
but what I'll say to Matthew though is that if he can track his own expenses in some way and just look at how the price changes over time, I think then he can know what his own personal inflation rate, so to speak, is. But that's a lot of work, and honestly, I mean, I don't even do that for myself. But it's something you could do if you're really interested.
Hey, on this vein, we can look at something called the Chapwood Index. So it's an alternate measure of purchasing power that U.S. investors use sometimes because there's a question around CPI and whether or not CPI is reflective and all of these things. But what's interesting is that the calculation mechanism for CPI has changed since the 90s. Not in Jamaica, not talking about Jamaica, I'm talking about in the US. So there's a school of thought that it's not reflective. So the alternative, well, one alternative is called the Chapwood Index. And what it does is that it calculates the cost of living for persons living in particular areas, metropolitan areas. So people can look at that and then look at CPI to kind of put things into context and say, okay, reality is maybe in between the two. So it's just an interesting thing that you can look at the Chapwood Index.
Guys, Neville come with a very good question, and this is something that I account for in some form in my portfolio in Excel. Neville saying I'm not agreeing that USD is fueling pass through inflation. It may have been true in the 90s, but not so much now. But guys, what about using cost of funds as an idea or target for portfolio growth? Never let me touch on that for that first said sentence first. So the central bank has done quite a few research papers. I believe the most recent update to that paper on the pass through may have been sometime in 2021. And they would have stated that the pass through rate, which is effectively how transitory inflation is, or how um, a move in the rate or FX rate translates to a move in inflation at its most basic form, is very low. So that's actually a part of the bank's argument that they don't need to target FX. FX can flow as it does based on demand and supply. What they need to target is purchasing power, which is inflation. So that's just a backdrop. Do I believe that? We can say that on another platform, but what I can
Yeah,
say,
definitely.
what
Reserve
I
comments.
can say is that the average man on the ground um, that that purchases goods every day is not seeing that low pass through. Guys, what about using the cost of funds as an idea or target for your portfolio growth? Stuart, what do you think?
To be honest, I need to understand that better. When you said cost of funds, you mean what do you mean leverage?
Yeah, so I know what he's alluding to, and as I said, it's something that I look at as well. So, as you know, Stuart, with portfolios, the larger portfolios that you may look at, for example, a unit trust, a cost of their funds is the legal fees, the administrative fees, but it's also your leverage, as I said a while ago. How much did it cost you to get this money, right? I suspect for investors that don't invest, the cost of funds can either be on the easy side, which is zero, or you can calculate what's the cost of your equity, of putting your equity
Hmm.
into this project. Yeah,
Yeah.
so I think that's what he's alluding to. Yeah,
Okay. I mean, I might give this one to you. I'm not really an expert on that idea, so I can
yeah,
leave
I'm
it
not
there.
I'm not an expert either, but I touch on it. So
Okay.
what I'll say, Neville, what I'll say, Neville, is if someone is using a portfolio that is leveraged in any way, and just for the newer investors, leverage just means debt, right? So when you hear leverage, think debt. In this on this platform, if you use leverage in any way, let's say you borrow a margin loan or an unsecured loan for 10% in order to invest, the cost of you getting that amount of money is what Neville is calling your cost of funds. Naturally, if you are investing, you would hope that the return that you make on your investments is more than the cost of acquiring the money. So that in that respect, you would get a levered return. And generally, once the investment return is larger than the cost of funds, your levered return is usually more than the your return if you had used your own equity. So certainly, Neville, people, if you're using leverage margin loans, I know a lot of people will use margin loans. Ensure that what I do when I use margin loans, I start a new sheet because, as I said, my Excel isn't that technical. I start a new sheet and I say this is the amount that is borrowed. This is the amount that accrues every single day. So it updates every day. The formula has a today formula in it, so it updates every day. And so this is I can look in the sheet and know what the cost of my loan is today, even if I'm paying it at the end of the month. Because the stocks that I invest in, I can look at data from the stock exchange today and see how they've performed. So in that sheet, I will say this has been the cost of my funds. So let's say the loan is simple $20,000 a month. And my objective is to invest and to make more than $20,000 a month. On day one of investing, my cost of funds is going to be 1 over 30 times that 20,000. Whatever that number is, Stuart, you are the math genius. And then I will track the cost over the return for whatever I invest that money in specifically. And then I will also include the stock in my total asset portfolio as well. I don't know if that was clear.
We can spin it another way too, because what we're really talking about is a carry. So when you have a hurdle or a cost dealing with, and we have to surpass that cost, then we call that a positive carry, given that we beat the amount that we're trying to make. And if it's lower, then it's a negative carry. A carry is just the cost. It's just whatever you need to surpass in order to meet your objective. So we can think about it within the context of housing, because returns are not limited to stocks. So let's say, for example, we buy a house, right, or we buy a property, and that property, we use the leverage to purchase that property, and we have to service that leverage. Let's say, for example, it's 5% per year. We have to ensure that whatever return, the net return on the rent is higher than the 5%. That's how we get a positive carry. But if it was less, then it would be a negative carry. So that's another way of looking at the question that we're looking at.
I have a question for Neville, and it's based on this comment. So he says, right, I am also advancing that you want to include the idea of the cost of funds as a first step assumption. I assume when you're calculating your rate of return or your portfolio returns, whether or not you are using levered funds. What I would ask though, and I know how I would look at it, Neville, and you can comment. If you are using your own funds, what is the cost of funds measure that you would use? Would you recommend the investor calculating a cost of equity equity in a way, because it's your own money that you're putting there, where the cost of equity could be just the opportunity cost of that money being in your portfolio. So Neville, you can just answer that in the comments, please. But
So like
I'm
investing in an index, for example, right?
yeah, so you could easily put the funds at, I don't want to be biased. I was about to say a specific company, but I don't want to be biased. So you could put the fund in a bank account and make 4%. Guys, that's not real. And make 4%, right? You can do that. If you do not put the money in the bank account and you choose to put it in your investment account, then the opportunity cost of you putting that money in your investment account is somewhere around 4%. So that's what I'm talking about. Correct, Julian.
Yeah.
Yeah, I think this was a good session.
Yeah, man. We're actually coming up on time, boy. Stuart, Julian, when we started the session, Stuart said he's very efficient, and trust me, he has proven to be actuary. I was trying to find an adjective for actuary, but he's he's proven to be very efficient with the time. So we can take any more questions here. Stuart touched on most of my questions really in his presentation, particularly when it pertains to cash, using the money weighted versus the time weighted versus a simple yield. We spoke about cost of funds and how that should be included in analyzing our investments. Oh, Matthew is saying, did you guys go over portfolio tracking apps? So, I mean, Julian, what do you use to track yours? and Stuart, you can chip in as well.
It's a nice app called Microsoft Excel. Yeah,
Yeah, I
I'm
use
a simple guy, I can't deal with all the drama.
Yeah, I like Microsoft Excel because what I showed you was just a simple portfolio. Me personally, I have more than one. I have investments outside of the Jamaica Stock Exchange,
man.
and so
Geographic diversification.
and so I have to. I think Excel for me gives me the most flexibility to monitor the investment returns. I'm not aware of all the different type of investment tracking apps out there. So if anybody out there can drop some in the comments, would appreciate that.
Yeah, man. So me personally, I use. So I'm aware of other platforms. I don't think Jamaica has the right platform as yet. Like, well, for me, I use Interactive as I told you, Stuart. Where on Interactive, I literally don't need to do any work. I don't need to have an Excel sheet. I just go in there and it can all be there. And if you're in the US and investing in the US, there are apps that can incorporate your investment accounts and your bank accounts and do all of that. I use Microsoft Excel because it's extremely flexible and I can use it. I can really use it. Matthew is saying he proven has an app, so we can use Proven's app as well. I won't shade anybody on this call. My Money JA is pretty good. That's by the guys over at Earnings Season. That's Randy and it's Randy. It's Randy. I was going to say Randy and then but it's Randy Rose platform. Neville had a comment here, and Neville, I was agreeing with you up to this point. So he said, I am recommending the use of a standard cost of funds, not the CD rates and such, but rather say the rates on corporate bonds and such. Now, Neville, I can't use uh, an opportunity cost measure for my cost of funds if I can't invest in it. So I can't say that my cost of funds would be corporate bonds if I literally cannot meet the minimum for investing in corporate bonds. And then corporate bonds have a few more technicalities. What rating class of corporate bonds um, would I use as it pertains to this specifically? Um, yeah. So what rating class and what tenure? So I wouldn't use that per se. I would probably go more with something that is, I know that realistically I can put my money in that if I choose to tomorrow. I don't know if the other guys have a comment
Let
on
me
this.
let me try to understand though. The point of this cost of funds is to really take into consideration the opportunity cost. What else? Um, Sorry, not opportunity cost. The fact that the money that you're using has a cost attached to it. Yeah. Why
Mhm.
is it that you'd want to put that directly in the portfolio as a cost? Is it that you want to put it in the portfolio as a cost item, like an expense?
No, I'm probably thinking that the person is looking at it from the standpoint of having it as a discount rate. Um, that's what I think. That's my
Oh,
interpretation.
okay, but that's valuation, right? That's completely different to the actual return itself. The
Yeah.
return is the
I,
return.
w- I was thinking a bit different, Julian. I was thinking that if you're using the um a measure for your cost of funds that is equity related, it would more be looking at what is your implicit cost of investing, or your economic costs. Now we know that economic cost is different from the accounting cost. So when you're doing your leverage, that's an actual transaction. So that's your accounting cost of doing the transaction, the cost of the leverage that you put there. But if you're including a cost of equity, which is really an opportunity cost, it moves more to the economic or the implicit side of that transaction. And you know, the other thing I think investors may, most investors just may not be in a position to be able to estimate their cost of funds for specifically when we're talking about the economic side of the transaction or the economic or implicit costs.
Yeah, I personally, I don't know if I would factor that into my overall returns if it doesn't have the accounting cost that you just mentioned. So if I don't have leverage, if I don't have a what you call it, a margin loan, then I'm not gonna put in that in my portfolio. However, at the end of the day, when you select your different investments, you must have some hurdle rate or a rate that you a target rate that you want to achieve. And from a portfolio level as well, you have a rate that you can benchmark the performance of your portfolio against. So I think that's where you can capture that idea of opportunity cost.
Yeah, 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 man. I think you said it well. Well, we are now at the end of the session. We're coming up on an hour and a half. But it was a very rich conversation about portfolio, and I find that we don't have this conversation enough. So this video will be made available on YouTube in a few days. So look out for it, and we will certainly post it. Well, post an update when it is uploaded. I want to really thank Stuart again for taking time out of his busy schedule. And I know it's around curfew, and probably having dinner to eat with just sharing this with us and sharing a very good presentation. I realized that even though he's a numbers guy, he did his very best to ensure that even though this is a topic where you cannot avoid numbers and formulas, he did his very best to ensure that the numbers and formulas were at a minimum, with the understanding and the reasoning about it being at the maximum. I really appreciate that, Stuart. And thanks, Julian, who's a part of our SOTR team, a senior rocker himself, for passing through. You know, Julian is a prime minister youth awardee. You know, so it's always very good to have his time here. Thanks again, guys. We really appreciate it, and thanks to the audience. Crystal is saying this was excellent. Thanks again, gentlemen. Yeah, man, no problem. Crystal, that is fine. Thanks again, gentlemen. Any final word from any of you?
Oh, I just remember somebody asked a question about fees on the market and whether or not they were changeable based on the index, whether it's a junior market index or the main market index. That's no. Whenever you're doing the trade, it's the same amount.
Okay,
Just to
yeah,
answer the
that's more
question, yeah.
honest. Oh my, Stuart, apologies. If you have
Mhm.
2 more minutes, I think we missed a very critical question
Okay.
by Andrew B. I don't want Andrew B to think that we're avoiding the tough questions, He
I'm a very
stated
this is
that
Andrew B. I know. Yeah.
would an explicit, when you say explicit there, is a technical man. This, when you see when would an explicit numerical target range a more appropriate benchmark based on an expectation of long-term inflation plus a spread of 300 basis point for investment benchmarking?
Would an explicit numeral target or range should that be a more appropriate what?
Yeah, he's saying
Yeah.
what about a hurdle rate of long-term inflation plus 300 basis points, which is 3% for
Three
people who,
percent. Yeah, yeah.
who don't know.
I mean, at the end of the day, right? It's down to one your risk appetite. It's down to your available universe of assets that you can invest in, and it's down to your overall investment goal, right? The higher up you go up the tree, is the more risk you have to take. So when you go long-term inflation plus 3%, you're taking more risk than somebody who's at the plus two. Um, so I would say you have to revisit your goals and the purpose. What's that? They are in the smart, the relevance of the goal, and you factor that into your overall numerical target as to what you want to target for your overall benchmark rate. But benchmarks are completely different to cost of funds, and they're actually very different to the actual inflation rate, for example. So whatever you use to choose as your benchmarking rate should really tie up with your overall investment goal and the vehicle that you're using to achieve that goal.
Yeah, and as you said, your market makes a big difference because which long-term inflation are you talking about? Long-term US inflation or
Correct.
long-term Jamaican inflation? Because that's two different arguments. So it really depends.
Thanks, Andrew B, for that question. We appreciate it, and thanks again for the listeners for staying with us for the hour and a half. We really appreciate it. Thanks again, guys. See you next month.
All
Take care.
right. Yeah,
All right,
man.
guys.
Salute.
Thank you very much. See you soon.